I've got to give it to the bulls, staying strong in the face of a hot CPI print on Tuesday morning, ironically gapping up, at least that is in the S&P 500. We are technically getting some mild divergences in the NASDAQ and the Russell. We'll dive into that nuance as we build a logical game plan for the remainder of this week. As always, check out the links listed down below in the description, hit the thumbs up button and subscribe, remember 100K by May, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So kicking things off on the SPY daily time frame, what do we see in terms of trend? Coming all the way from the lows, we've got higher lows, big set of higher lows here, and Monday actually gave us the ideal higher low that we expressed in the Saturday weekend update. And from there, we've basically traded back up to the equal high, right? We had highs, higher highs, and a new all-time high was produced on Friday. For all intents and purposes, these are basically equal highs on the daily time frame chart. So trend remains up and we're sitting on an equal high. That really leaves us with 2 potential outcomes as we move into the end of this week. The first and most straightforward is breaking out up and over now the 1, 2, 3 touches all towards the same level at 518, unlocks blue sky territories and a brand new all-time high. That gives us an opportunity for trend continuation because we would be making a higher high in the trend cycle. The alternate outcome would be a deeper pullback, and by deep, there's big air quotes around that one. We're just looking for another daily higher low, but this time up and over the 512 level on the daily time frame chart. Remember that 509 was ideal because what that represented was this as a balance range in the past. So beautiful higher low hold there. We really don't want to go back down towards an equal low, especially coming from an equal high. If we were coming from a higher high, it's a slightly different story, but if there's weakness into the end of this week, the main level I would want to see act as support is right here at 512. It's Monday's high of day. It's also the Tuesday gap fill reversal, which is a great segue into market structure here and what's happening with the bars. On the Monday session, beautiful hammer candle. Again, the bears did have some momentum coming off of the bearish engulfer on Friday. Saw a little bit of continuation to the downside, but the buyers stepped up exactly where we would have expected them, and we closed over the opening print, even slightly inside of the Friday range. That's a big win for the bulls. The next day, we gap up on CPI, which is somewhat ironic, but regardless, we go for a gap fill reversal, and then there's pretty decent range expansion in the upward direction back up towards this equal high. Another big win for our bulls, not allowing the intraday selling pressure on the morning to really battle for price acceptance, sellers that is, price acceptance inside of Monday's range. It simply didn't happen. We didn't find any acceptance underneath this 512 zone, and obviously today speaks for itself. It was a very, very mild consolidation day inside bar, which is technically speaking a 3-bar play, a bullish 3-bar play, where this represents bullish upside momentum. This is a pause for consolidation over the 50% mark of that range. If we can break the equal highs here, it's off to the races for trend continuation as we've already outlined. Of course, what's the bearish caveat here? If this is going to turn into a double top, if we're going to get 1 and 2, you're probably looking for a breakdown of 512, either a lower high underneath or just break the neckline, which is here at 509. And then the larger threat on the daily time frame chart, of course, is the equal lows down below at 505.25. I would really make the argument that this 505.25 would be the structural gatekeeper for the NVIDIA earnings gap up. I wouldn't necessarily want to wait for 503 if we're clearly getting lower high acceptance, and I get it, we're projecting here, this is total speculation, but if you're a bear, this is basically what you need to see if you're looking for that gap to close, right? You're looking for price acceptance under that 505.25. Based on all the evidence that we've walked through so far on the daily chart, not only the Monday higher low beautiful hammer candle, the Tuesday gap fill reversal, but also today's inside bar consolidation, to me, I would be more partial to the upside, but I am willing to change my tone if this market wants to give us initially price acceptance underneath 512. What does that set up? You guys know this pattern like the back of your hand by now. It's the Man Ray pattern. And of course, we've got it trademarked, so let's not get legal involved. But if we get the Man Ray pattern here on the daily, of course, things are becoming threatening to the downside under that 505.25 neckline. We're not there yet, but again, to at least acknowledge what the bears want to see, that's the danger. This is where the bears get active. I would say that this looks good for continuation. This looks good for continuation. This looks good for continuation. We'll only become more concerned if we start to get something that looks like this on the daily time frame chart for a trend reversal. On the hourly time frame chart, we'll do the same exact thing. In terms of trends starting from the Monday session, we have lows, a higher low on the gap fill reversal from Tuesday, afternoon higher low, and today, during that end of day volatility, we technically speaking have the opportunity for an hourly higher low. Along the way, Monday's high, Tuesday's morning high, afternoon high, and an equal high into this afternoon's consolidation. So I think that we're definitely in an hourly uptrend with the opportunity for it to potentially reverse or yield a stronger daily pullback towards that 512 that we've already discussed. So what are the outcomes here on the hourly that give us alignment to the daily pathing? Well, obviously, consolidation up and over 515.25 looks great, and we're really using 515.25 because that's, in my eyes, what really represents where the sellers tried to make a stronger foothold in the market with the bearish engulfer on Friday, right? Failing underneath the Thursday high after an opening drive to the upside, breaking down through that opening print. In my eyes, that's the key inflection point. So any consolidation above is bulls on parade. You could even make the argument that this is somewhat of like an hourly cup and handle, and over time we'll look for that to break in the upward direction. Great, fantastic. If we start to break down underneath the 515.25, just like we had a Man Ray on the daily time frame chart, here it is on the hourly, lower high and then through this as sort of a neckline, break down here, you could probably trade this as a scalp into the end of this week into 512, but when and if we get to 512, as we've already mentioned, we're looking for the buyers to step up for a daily higher low. Lows, higher lows, and higher lows on the daily time frame chart. So double bottom, inverted head and shoulders, and the very classic hammer candle that we're always looking for. Any of those setups go, any evidence that buyers are stepping up. 512 is a big important level into the end of this week. So that's what the bulls want to see. As we've already described in the daily chart as well, the bears are really looking for a breakdown through that, lower high underneath, and then maybe we start to get that Man Ray on the higher time frame that might start to look something like this. Again, what does the evidence suggest? Specifically on the hourly chart, we can see this on Tuesday's session, right? On the gap up, there's an opportunity to close the gap and then we rally back in the upward direction. The bears would have had a much stronger look, or even more of a neutral look, we could argue, if we actually rejected underneath that 515.25, right? If the daily chart was going to yield some sort of lower high from here to here and less so of an equal set of highs from here to here. I get it. We could split hairs and say, technically speaking, these are lower highs, but primarily if the structure was going to reject, right, you still could have gone for the gap fill reversal and gotten a lower high. It simply did not take place. And until the afternoon volatility today, all of the price acceptance has been above that key level, which we've already talked about, right? Coming from the Thursday high of last week and the Friday opening print. So in my view, the fact that we're consolidating above is more bullish than bearish. The fact that the sellers could not yield a lower high here underneath the level is more bullish than bearish. And for those reasons, I'm trying more so to align with outcomes that look like this in the upward direction, this in the upward direction, or this if we pull back first, then looking for upside. And as we've already mentioned, we know, and we'll even use the red crayon today, that the sellers start to feel emboldened on a lower high underneath 512. If we take out the intraday anchored VWAPs, there we go. We can certainly see that over time, and again, this is no guarantee that it even happens into the end of this week, but slowly over time, I could envision that these start to play catch up and offer confluence around 512. Remember that this is pre-NVIDIA earnings gap up and post-NVIDIA earnings gap up, basically representative of anybody who's long from this consolidation. They would like to see, ideally, price stays over those anchored VWAPs. The quote average shareholder, the average buyer, will be above water, green on the position, if we're over those anchored VWAPs. So 512, if we can get confluence with them, fantastic. Maybe that's Friday, maybe it's early next week. We are yet to ultimately see, but I do think this is at least reasonable for a short scalp to get there in the first place, right? Even though we've got a couple of anchored VWAPs in here, I would really rely more so on identifying that we have thin structure through that move on the Tuesday morning session and say, okay, if there is going to be a daily pullback, we're trying to look for another higher low, you could probably take a stab short at this market, but just please do not overstay your welcome at the 512 level. As we'll see on the internals in just a second, there's really no stronger evidence that sellers are stepping up in this market. As a matter of fact, let's just go there now. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. If we look at the market breadth all week, it's been positive, right? Even as we sort of gapped down on the Monday session, breadth was positive on Tuesday when we got the hot hot CPI. Technically, we closed green on the day. On today's Wednesday session, we're certainly green. I wouldn't make the argument that we have really strong buyers. We nowhere near 300 million in the positive direction. The advanced decline line is a little bit trickier, right? Because technically we open negative but close out flat. Open positive or right at the zero line, big drive lower. A little bit more neutral on Tuesday. Remember that this is CPI day right here. So surprising to see that at the exchange level, it's not just the S&P being driven by, again, people like to just lean on NVIDIA and say it's the one stock to rule them all, which I get it. It's certainly important. But at the exchange level, even with a hot CPI, we were able to close out the advanced decliner closer to the zero line instead of a big build to the downside. On today's session, strong out of the gates, flat into the afternoon, a little bit of pullback here, but again, all happening over the zero line. So as I continue to ask myself over and over and over again, do we have any evidence of stronger sellers participating in this market? The answer continues to be no. Even if you look at the cumulative build on the tick into the afternoon today when we got that volatility, you might say, aha, there they are. There are the stronger sellers. Let me just remind you, if we give ourselves a little bit more context, strong reads, these are not even strong bullish reads. Strong reads are 5,000 net positive or negative. We hardly scratched at negative 1,000 into today's close on that panic sell in here. So again, as we ask continuously the question, are stronger sellers getting involved? The answer continues to be absolutely not. We don't have the utmost confidence in the buyers either. Let's be very clear about that. I don't look at this and say, oh my goodness, it's time for a new all-time high. Great, we're in trend higher zone all week. Oh my goodness, look at these huge, big bullish builds out of the cumulative tick. That's not the case either. I'm not trying to, be overly bullish when there's no reason to be. But in the absence of stronger sellers, what's the saying, right? Never short a dull market. And this continues to be the case in what we have in front of us here. Even if we look at futures into the end of today's session, big dump on volatility, retraced in its entirety. So what would that suggest? This is nothing more than liquidation break. You had longs late to the party up here with pretty terrible location, I would argue, as the market didn't do anything all afternoon. If they decided to close out, there's your volatility to the downside. Everybody just picked it right back up, right? So liquidation break is actually bullish for the market. It takes out short-term momentum sellers, because any short who's getting involved in this, seeing a 100% retracement likely into the close has already closed out, right? The short scalp is over. It's been retraced. There's no evidence of stronger sellers stepping up here, or even over here. So I really just boils back down to this point, which is if there are no stronger sellers, I definitely wouldn't want to be short. Like, I can understand being a little bit skeptical of an all-time high breakout here, and we'll get into posture in just a second with the sectors as well. Like, I can understand the skepticism, but the market's just not a short. It's been in an uptrend for a while, weekly, daily, hourly. We're still in those time frame uptrends. Maybe something happens on triple witching Friday, but until the structure actually breaks down, the market is simply not a short, and we're looking for pullback buy entries or reasonable breakouts where we can manage our risk. And I would say, given what we have here today, especially on the daily chart with a 3-bar play in the upward direction, I would tend to think that this is a breakout we might want to participate in, even if it's with smaller size. And if you don't want to participate, that's fine. Just understand that the market does not appear to be a glaring short at this moment. And our final add-on for the S&P is going to be the market profile. If you're not familiar with this screen, check out the video tutorial in the top right-hand corner. And this really ties together everything we just discussed about the liquidation break into the afternoon, right? Here's Monday's value area. It's lower still. Great. Longs are positioning at decent location. On Tuesday, you can start to see that the long position migrates towards the top of the range, towards the all-time high as well. Notably, the point of control is above the value area high from today's session. The reason that this is somewhat important is because it totally sort of, in my view, validates the liquidation break into the afternoon, right? So as we're just going sideways, and notice the incredibly poor high at today's session. That needs, it doesn't need technically anything, but in theory, auction theory would suggest that we would like to repair that poor high and end the auction properly at the top. So what would repair that? Obviously a break through it, right? So that's one reason to believe that the 3-bar play might be a decent idea into the end of this week. Even if it's just for a pop in the upward direction, then maybe it fails into the early stages of next week. That's fine. But given the information in front of us right now, I would tend to be more partial to the upside. If we look at the lows of all of these sessions as well, here's the Monday session, B period, great excess. A period on Tuesday, great excess. And L period here, as we got that liquidation break, great excess at the low. So the auction has ended properly. At the bottom of all of these sessions, it's ended improperly. I would argue lack of material excess here, lack of material excess here, and certainly a poor high on today's session. all of that sort of comes together in my view to inform a decision that, okay, if we're looking for that big exuberant excess high, the market to go out on a bang, we're not quite there yet, and we can possibly participate in upside to get to that exuberant high, the excess high, before possibly the market reverses for another stronger daily pullback. As of right now, I think that this totally aligns with all of the analysis we've already performed in the candlestick charts themselves. So if you think I'm the permabull of YouTube, think again, because here we go on the QQQ daily time frame chart. We've got some glaring issues out of this side of the market. It's a little bit weaker than what we've already expressed over in the S&P 500. This is the divergence that we were already talking about in the intro. Look at the opportunity for a daily lower high here after actually breaking down through the key structure at 438.50 on the Monday session. Now, let's not get it twisted. We didn't come all the way into an equal low around the 433.75. We did technically produce a hammer or indecisive doji on Monday. Tuesday gives us the gap fill reversal, a strong close, at least on that daily session, back up towards the high of that daily session. But today we just have an inside bar, which is actually closed back down underneath the level that ideally would have offered the same equivalent 3-bar play in the upward direction that the S&P has, right, over this sort of structural component of the Tuesday session. We'll see that on the hourly chart in just a second at 441.50. So as of right now, I have to remain neutral on this chart, right? We don't really have a firm set of higher lows. Maybe if you want to split hairs with me, it's an opportunity for a higher low, but pair that with the lower high that's kind of in force from here, and we're actually getting range compression. You could make the argument something that looks like this. Now, I'm not a huge fan of triangles, symmetrical triangle, this, that, the other thing, but if we can get out of this range, that's where I think the market really starts to offer a bit more clarity here in the NASDAQ. So obviously buyers would like to see a push up and over 446.50 into blue sky territory. Sellers would like to see a push into the NVDA earnings gap to close it down towards the daily 50 SMA and 425.75. When we're in the midpoint of a range like we've closed on today's session, I would tend to, sort of remind you that we don't necessarily have an edge either up or down. Today was totally an inside bar contained within the range of Tuesday. And again, maybe this lower wick would suggest that buyers did step up, but we also have clear evidence that sellers are continuing to put downward pressure into the NASDAQ side of the market. And if we really think about this from a 90,000 foot view, what does weakness in tech suggest? Obviously, your S&P 500 is largely comprised of the tech sector, right? It's the heaviest weight risk on sector. So if the NASDAQ is going to break down through possibly the bottom end of the range to close the NVIDIA earnings gap, of course that spells trouble for the S&P 500, and that's one of the larger concerns I have as we walk forward with the market under its current circumstances. So daily chart out of the NASDAQ, neutral until proven otherwise. We have highs, technically speaking, a wick higher high, but for all intents and purposes, equal highs up here and equal lows down here. We're compressing in the midpoint of the range. The daily chart is not really showing us what we want to see in order to have an edge. If the buyers were going to have something more substantial going on here, ideally consolidation just would have been over 441.50 for something that looked like this. Right now, all of a sudden, this looks like a higher low, flat top, ascending triangle. Maybe we get the break from that perspective, right? Not the case with the close today underneath 441.50. Same thing for the bears though, right? We have to at least acknowledge the green close here from Tuesday. If the bears were going to have a better time, I really believe that failing this level here at 438.50 could have yielded on Monday, that is. So on Tuesday, if we had opened up underneath, this would have been much more of a threat for obviously the breakdown happening sooner into the NVIDIA earnings gap. So it goes both ways, just like the buyers didn't really give us that consolidation over the 50% mark. The bears also didn't take away a huge win with consolidation underneath the 50% mark. So let's get a little bit more clarity by dropping on down to the hourly time frame chart. And you can still see if your counting trend may be a low, maybe a higher low, maybe a higher low, but along the way, highs, possibly lower highs into this afternoon session. You can see where this inflection point is coming from at 441.50. Here it is on the Wednesday high, Thursday low of last week. And look at the Friday afternoon lower high that's set here. We know that the bearish engulfer on the Friday of last week in the NASDAQ was much stronger stronger for the sellers compared to the S&P 500. So for that reason, we're really using that afternoon lower high, which is also structural here, here, and here. Look at the midday pullback level on the Tuesday session and afternoon lower high on today's session. So for those reasons, a little bit more bearish biased here on the buyers failing to hold this as an early indication of an uptrend, right? If this was going to be hourly low, higher low in here along the way, highs, higher highs, higher highs. Ideally, that higher low either wanted consolidation over the level or continuation, certainly not a lower high into the afternoon underneath at 441.50. So for that reason, on the hourly chart specifically, I would look at today's session as a win for the bears. With that lower high, we were not able to get back up towards that opening print, and in my view, it really sets up more of an opportunity for a breakdown here, again, underneath that key daily level, which we had already discussed at 438.50. If we break down underneath that off of a more meaningful lower high here on the daily, it really, like, we're already halfway there for the Man Ray pattern, right? Here's your sort of Man Ray, there's your right shoulder. It's already being put in force, right? We have the lower high, we have an intraday lower high happening over here. If we can just trade down towards these equal lows, I really think that the NVIDIA earnings gap is much more of a threat, obviously, here in the, I was going to say NVIDIA, but rather the QQQ tech side of the marketplace. So fairly straightforward on the QQQ. Any continued consolidation below 441.50, I would be looking for equal lows to emerge on the daily time frame chart. Obviously, stronger shorts are once we actually penetrate into that gap that's underneath 433.75. If you are looking for upside, you really want to see a recapture here, then I'd probably be looking for a breakout over the highs of 444.50 to trade back up towards the all-time high would be the target up there at 449 and the upper edge of this week's expected move. Based on the interaction today, I'd be slightly less aligned with this sort of pathing in the upward direction and more so aligned with either continued neutrality or possibly a slip to the downside. Again, we'll see if the triple witching on Friday has any sort of volatility add here, which accelerates that type of move, but that's what I'm primarily concerned with here. Let's take a look at the intraday anchored view apps for the NASDAQ, and unlike the S&P, we're just tangled in between them. So again, do we have a clear edge here? The answer, in my view, is not really. If it was stronger, we would have stayed above that cluster of anchored view apps, above the key structure. If it was weaker, we certainly would have been underneath and staying underneath, rejecting that for lower highs here on Tuesday, on today's Wednesday session. And that's also not taking place. So trying to take a very balanced approach to the NASDAQ, but at least recognizing the risk of a possible daily lower high that's already been set here. All it would require is just that equal low. So you can see that we're trying to navigate this through the lens of prioritizing for risk. If we can understand where the risk is and to step out of the way on the long side, you're going to be less likely to get hurt, especially if you're just trading the S&P as well, right? You really need to be aware of both of these things. Let's take a look at the internals for the NASDAQ side of the market, and you can see that we're much weaker over here. We do not have inflows on Monday, Tuesday, or today's session closing negative. If you look at the advanced decline line, negative, negative, and even getting negative on today's session. So at the exchange level, the NASDAQ is certainly weaker than the S&P 500. Same thing here with the cumulative builds. Much stronger read on Monday, but just a reminder, this is also not a blockbuster read, negative 5,000 or whatever we might classify as substantial, which just is negative 5,000 in the case of downside. So we're not there yet. So more of a neutral but slightly skewing bearish outlook on the NASDAQ for all the reasons we've described already compared to the S&P 500. If we take a look at the market profile, you can see that this is overhead supply. You can see that the point of control from today's session is right towards the lows there. So again, what would that sort of suggest? That any buyers late to the party towards the highs of Tuesday's session are underwater. That it's going to add overhead supply selling pressure to this market, making it easier to get back down towards that equal low. If we take a look at the highs of these sessions, notice excess high on Tuesday, excess high on today's session. This is already repaired because we traded through it on Tuesday. There's no improper end of the auction at the highs on the NASDAQ. So therefore, we don't have that same sort of auction theory telling us that we want to trade higher to repair this structural level. No, we're all set there. We're all set here. We do have good excess at the lows as well. So it's not like we have the complete inverse with poor lows, but it's less likely that, again, based on auction theory, we would want to see these levels repaired, being traded through again. As of right now, the biggest takeaway for the NASDAQ market profile is that this is more easily going to turn into overhead supply the more time we can can spend underneath in the NASDAQ futures, somewhere around 18,350. And if we were to go back on over to the price action charts, we would just know that that's loosely the equivalent of right here at 441.50. As long as we're underneath that, looking for continued pressure to build in the downward direction. And last but not least for the broad market is IWM Russell 2000 and the small caps on a daily time frame chart. What do we see here in terms of trend? We've certainly got lows, and an offering of higher lows here at the 204 level. Ideally, we trade back up towards an equal high 210, or generally speaking, just get price acceptance over 208. The reasoning behind that is we want to avoid not necessarily the Man Ray pattern, but instead the very classic head and shoulders. 204 would turn into the neckline there, and if we break down underneath it, technically speaking, we are drifting into a daily downtrend, but the bigger retest level is at 199. Daily 50 SMA is going to meet us there over time, and as we know, it's the neckline of this as a double bottom, or very simply put, the breakout point of an ascending triangle. But it's more important than just a structural pattern here on the daily. If we bring it way out to a weekly time frame chart, we know that this represents the breakout point of the weekly balance, right? Rejection, rejection, rejection. Now that we're above it, if we're going to offer a weekly higher low pullback, you've got to stay above 199 or 200, the nice round psychological number. And we just saw that it made sense on the daily chart as well in terms of pattern structure. And over time, if this breakout continues in the upward direction, it's going to dampen any of the downward pressure that any larger pullbacks in the NASDAQ side of the market provide for the S&P 500. Now, if the IWM fails underneath 200 on a stronger daily pullback and a breakdown of that weekly level, then yeah, run for the hills, duck and cover. It's not going to end well in the S&P 500. So the NASDAQ has a negative bearish divergence, whereas the IWM is trying to support the thesis that on the weekly higher time frames, we're still technically, big air quotes here, okay in terms of an intermarket relationship. Let's drop it back down to the daily time frame chart because I do want to talk about the structure that unfolded Tuesday and today's Wednesday session. You'll notice that Tuesday, we did print the hammer. We got the buyers to step up at this structural level, but today we found an upper wick rejecting this 206.15. Now, unlike the S&Ps and unlike the NASDAQ, it's the only index that closed green over the opening print. So we're not going to try to discredit the buyers too much, but a stronger look would have been closing at the highs of the session up and over that particular level. If we drop it on down to the hourly time frame chart, we can start to see how we were really just getting this pretty healthy looking consolidation, possibly setting up for a breakout to continue towards that 208, which remember is an objective of the daily time frame chart, and the end of day sort of breakdown I wouldn't say completely ruined it, but throws a wrench in the mix here. So as we walk forward, any acceptance under 206.15 continues to threaten the head and shoulders, and we will be concerned underneath 204. We were talking about 199 as being the lifesaver on the weekly time frame chart, but obviously to get there, if the market were to break down underneath 204 into the end of this week, it probably spells trouble for the S&P 500. I would only just, I would keep in the back of my mind when and if we approach 199 that you want to keep a very open mind to changing your tone in the S&P 500 if small caps can find buyers at that weekly area of support. We're not there yet, but we just want to be aware of that considering what's starting to emerge here as, again, a little bit of a head and shoulders look here. Underneath 204 is where the threat becomes much more real. If we start getting price acceptance into the end of the week over 206.15, I would just make the argument that we're building a constructive hourly uptrend, and perhaps we start to get something that looks like this as a trend line. If we could start to clear that 208, much more of a feeling of confidence in the S&P, even if the NASDAQ is breaking down aggressively. Like, think about it today. The IWM closed up 41 basis points, NASDAQ down 54 basis points. It's sort of like, obviously the S&P was down 22 basis points, but instead of being down a full 0.5%, it was almost diminished by half because small caps were green. Now, again, is that exactly why that happened? Not exactly why it happened, but it starts to help you conceptualize and put concrete numbers around the relationships between different market indexes. So hopefully that sort of helps. If the IWM is going to stay, somewhat resilient here, it's going to dampen the blow of that NASDAQ side of the market. So those are the levels that I would primarily be concerned with here. Let's take a look through the lens of the intraday anchored view apps, and you can see that these are actually perfectly supportive of the levels we've just outlined. Underneath 204 gets dangerous. We're underneath all of the anchored view app cluster. If we could recapture 206.15, certainly helps the bull case into the end of this week. Let's take a look at the Russell internals. They are definitely more bearish than what we saw out of the S&P and the NASDAQ, even with a net volume outflow on the week more substantial here. Advanced decliners were mostly bearish, even closing negative on today's session, and the cumulative build much more substantial. The Russell does not aim for negative or positive 5,000. It's a little bit diminished. It's certainly closer to 2,500. It's about half is what we would consider substantial. So 1,700 in the face of other indexes that were fairly neutral on today's session into that afternoon dump. A little bit more worrisome here, which potentially just reminds us that the threat underneath 204 is a very real one, especially for the implication in the S&P 500, right? Let's go on over to the market profile side of the Russell and see what we can learn from over here. This is somewhat encouraging and sort of flies in the face of what we just saw in the internals, which is on the Monday session. Here is that sort of weakness, right? And you can see the consolidation on the lows. Poor low is repaired, lack of material excess down here. Value is more central on the Tuesday session, but look at what happened today, right? All of these buyers are validated by having that value area up and over and towards the highs of today's session. So yes, although we did technically produce an upper wick on the day, the value area, the price acceptance, was primarily higher up and over the Tuesday value area. Again, validating the breakout buyers there, or the reversal buyers up and over the high, right? So as we're starting to look for the IWM to potentially play ball here, to me it would make sense as long as we are holding over 204, you don't want to jump the gun to the short side. Why? If we just go back over here, the position is being held from loosely that area. Those traders were validated today. As long as we're just chopping around through here, I wouldn't really call it a short just yet. You would really want to be underneath that low, aka back over here, underneath 204, to start that aggressive breakdown of the head and shoulders to yield a more bearish outcome in the S&P in tandem with a weaker NASDAQ side of the market. Let's continue to get granular here and explore the weekly performance of our S&P sectors. Leading the pack is energy up 2.46%, followed by financials up 1.7%, and then the XLB materials sector up 1.64%. As we know out of that lineup, only the XLF is a heavyweight risk-on style sector. The XLE energy is lightweight, but not necessarily D for defensive, and the same thing with materials here. Lightweight, but not necessarily D for defensive. And it's not the end of the world, but it's somewhat concerning that, we're not seeing the XLY, XLK, XLC at the top of the list as we rebound off of a daily high or low into the equal highs. So will that change as and if we make a new all-time high? That is yet to be seen, but it will be something that we're watching out for. I would be much more concerned about this all-time high here, or the attempt to break out to an all-time high, if on this rebound you saw at the top of the list utilities, consumer staples, and real estate. That would be a huge red flag. Not at all trusting the 3-bar play in the upward direction, but because financials are performing okay here, I'm somewhat open to the idea that this could just be a trade in the upward direction. We don't want to marry this thing at the all-time high, but as a tradable outcome for higher, absolutely reasonable considering that financials are up substantially on the week, leading the pack here towards the top of the list. At the bottom of the barrel, we see the TLT, not directly an S&P sector, obviously, but it speaks to risk appetite, down 1.6%, obviously, on the inflation news on Tuesday. That sort of sent it in the downward direction. Then just underneath is that real estate sector, right? Hard assets being seen slightly more defensive there, down 1.02%. Then the laggard at the bottom of the green lineup is the XLV. Now, that's interesting as well because healthcare is D for defensive, yet it's the second heaviest weighted sector by market cap. So it's great to see it green on the week, but lagging the remainder of the sectors. So far, posture, it's not stellar. It's not what we want to see up here as we attempt to break to a new all-time high, but it's also not, again, run for the hills, duck and cover. Oh my God, we're going to zero. It's not the case at all. Let's take a look at the structural charts and see what's going on. So energy, big breakout here, but I want to draw your attention actually to a monthly time frame chart. Look at this thing. What is going to happen if this breaks in the upward direction in terms of inflation over the summer, right? We know that transportation services, if you've been paying attention to the CPI reports, it's really insurance, right? Transportation insurance is through the roof right now. But what if not only energy from a transport perspective, but also as we then roll over to the winter heating perspective, what is this whole energy breakout going to do as we walk forward here? To me, it's a big headwind for the Fed actually seeing energy set up for a possible break up and over 92. So watching out for that. that. But let's drop it back down to a daily time frame chart. Let's talk about what's happening into the end of this week, right? If we were to get a pullback, there's certainly an opportunity for a higher low over 87.50 or the larger breakout point here for the inverted head and shoulders. As long as you're over 85.50, I would tend to be more bullish in the energy sector as opposed to bearish. Let's take a look at financials, continuing to chug along towards those all-time highs. We're not there yet, but look at the constructive break, retest for a higher low, continuation in the upward direction. The chart looks great. There's just another opportunity for a higher low now over those two equal highs prior at 40.75. I would call it for round number's sake. Any consolidation above is great. Any pullbacks to retest that are fine as well from the daily perspective or even weekly perspective. Could accomplish something that looks like this. I wouldn't really be concerned. Of course, it means pullback for the S&P if the weekly is going to break down for that higher low, but as of right now, pretty strong close on today's session. Let's move along to materials, breaking out towards those all-time highs. Again, this is fantastic. Upward pressure is upward pressure, but it's a really lightweight sector, so it's not going to make or break the S&P 500 by itself. Next up is communications. I'll be the first one to admit, I was sort of wrong about the look above and fail. I mean, on the Friday session, look above and fail, I was expecting the bottom end of the range to come into play, but we're right back higher towards that 80 mark. Again, another inverted hammer on today's session, an upper wick kind of rejecting some of these highs, so it doesn't leave me with a warm and fuzzy feeling inside, but at least we didn't break down into this gap. So this does strike me as an okay look for the S&P 500. If it wants to continue, great. Give us a more impressive higher high, a closing higher high that looks maybe something like this. Then there's an opportunity for a higher low above the entire top of the range. And in communications, we know that this is a more risk-on style sector. Next up, we've got the XLK tech sector, the heaviest weight risk-on style sector there is. Notice different to the QQQ. We actually have more of an equal high being formed on the Tuesday session. We still have that inside bar and we still have some indications of like, okay, it could have been better, right? If we were holding up over the previous day's opening print, we kind of closed right on it. It would have been better to find something like the S&P, a little inside bar like this. But regardless, it's not as bad as the QQQ tech sector or tech NASDAQ 100, we'll just call it, right? So you're getting the higher low and opportunity. If we can hold on to this level here at 208, nothing really wrong, bullish consolidation, and again, it's starting to look more so like an ascending triangle. This is an outcome into the very near-term future if we can pop over 211. Where do larger concerns emerge out of the XLK? I would argue on price acceptance underneath Monday's low at 206, right? If we're going to battle back down for something like this, of course, the NVIDIA earnings gap is a possible threat. As of right now, with the lower wick on Tuesday and today's Wednesday session, a little bit more open-minded to something that does this and possibly breaks up and over those equal highs as we've just described. There's not as much of a threat for a clear lower high outcome in the XLK as a sector compared to the NASDAQ 100. Here is the XLP. Consumer staples moving in the upward direction. So D for defensive, absolutely. Lighter weight sector, yes, absolutely. Is upward pressure still upward pressure? Yes. Absolutely. So, any concerns here? Any big leadership issues? Is it taking out these monumental highs? The answer is no. We're approaching this one. Is it logical that we could get a pullback towards the bottom of the trend channel if you were to just sketch in something that maybe loosely looks like that? Absolutely. A pullback here would not be unreasonable, but it is not going to change the trend on the daily or even weekly time frame chart. So keep that in mind. A pullback is okay out of the XLP. Next up, let's skip over the S&Ps. We've already been pretty thorough on that one. Let's take a look at the XLY. Pretty good looking chart here. And the reason I would say that is look at the lower wick on the Tuesday session breaking down underneath the low of the Monday inverted hammer. I know this is a mouthful that had already previously rejected the multi-day balance overhead. Right, so Monday's upper wick showing us a rejection of this balance. Tuesday, we make a new lower low. And we do not get follow through. Instead, we close back up at the top of the range. So what is that? It's a very classic example of look below and fail. And now, with a sort of indecisive doji closing us back in the midpoint, I think it's a patience play. We will be more bullish for the broad market on a higher low in the XLY over 182. We know that this is a heavier weight risk-on style sector. So over 182, great. If we're underneath here, not so great. We start to get a little bit of that head and shoulder style look. I would really make the argument that your lows that want to break down are at 179.25. If you could capture those lows to the downside a little bit more aggressively, that would be where the sellers have something to trade for. This is an outcome probably yields. Again, more downward pressure, more of a headwind for the S&P as an index. Here's the SMH. What do we see out of semis? Mixed bag here, right? A little bit of a mixed bag. And the reason I would say that is inside bar, technically speaking, yeah, I mean, visually starts to look a little bit like a head and shoulders, but we're not there yet. You are getting some lower wicks on the Tuesday and Wednesday session. If we could stay over 224, I'd feel a little bit more comfortable about just sideways consolidation up here. If we're underneath, underneath, we start to get into that thin structure retracement over here, and then we're really dealing with a weekly higher low attempt. Remember that this is not the end of the road for the SMH. I mean, it could be ultimately in hindsight once we have that information, but not really in the business of stepping in front of a moving freight train. So still thinking about the opportunity for a weekly higher low in here. If it fails, different story. We'll change our tone when we have a weekly lower high, but as of right now, it's still pretty much long and strong inside of semiconductors. Is momentum slowing down? Absolutely. We would be foolish to not sort of at least acknowledge that. You can see that this engulfer has maybe changed the tone of the market a little bit, but we don't yet have a large breakdown. I suppose the daily trend flips to down with high, lower high, low, equal low, lower low, if we were to break down underneath this set, which is perhaps closer to 219.50, just for round number's sake. If we're getting acceptance underneath that, maybe the trend is down, maybe we start looking for more bearish outcomes, but we're not there yet. And once again, we have an inside bar with consecutive lower wicks showing us, or at least attempting to show us, that buyers are continuously showing up here, trying to get that acceptance over 224. So taking this one in stride, partial to the upside still, but willing to change tone when and if the right information is presented. We're just not all the way there yet. Industrials, new all-time highs on the Friday of last week, and continuing to trade back up towards them. This is upward pressure. This is bullish for the broad market. Looks great for a possible higher low here, long lower wicks. Buyers in control, no issues there. Utilities, any large glaring issues? Not really. It's recaptured the neckline of the double bottom. Consolidation for a higher low. Pullback for a higher low on Tuesday. Good to go. Anything that does this, fine, fantastic. Upward pressure is upward pressure. We don't really have a leadership issue with any, big time resistance trendline breaks, right? If something like this were to happen and, next week, let's say utilities are trading 75, yeah, red flag. What's going on here? Why is everybody flooding into utilities? But right now, controlled, slow, methodical, all good from a sector point of view. XLV, healthcare, what do we see here? All-time highs, by the way, up here. Just battling back up to try to recapture this as a balance range. Lower wicks attempting to do so. A little bit of bearish engulfing activity happening today with the gap up failing and attempting a new lower low, but not closing underneath the low of the Tuesday session. So still willing to give. I would say that this is, in some sort of twisted sense, kind of similar to the SMH, right? Where, maybe it's going to turn here, but we're not there yet. We've closed right on the level. This needs to resolve a little bit more firmly. If we trade back down towards this, then okay, maybe there's a bit of a weekly double topping activity happening here underneath 144.80. Starts to become a little bit more concerning, but again, we're just not there yet considering the activity from today's session. We'll take a look briefly at the TLT, moving in the downward direction, obviously, with the whole CPI print on Tuesday. We'll get into that in the fundamental section. And here's real estate, moving in the downward direction, obviously, sort of with the TLT as rates pick back up in the upward direction. But in the grand scheme of things, this consolidation as an inverted head and shoulders staying over the top of this as a previous range, I would tend to think that higher low retest over 39 keep us bullish on real estate, which I guess in the grand scheme of things is not the end of the world. Again, it's not really driving the return in the market right now, so I wouldn't look at real estate as a defensive, oh my goodness, flight to safety is unfolding here inside of our sectors. Speaking of risk on and posture, let's take a look at the ratio grid. If you're not familiar with the screen, check out the video tutorial in the top right-hand corner. We're still concerned in the XLK, and it's been that way for a while. We know that we've been going sideways inside of that balance range. This ideally perks back up if we're going to have a full-fledged risk-on style look in the market. But it's not fair yet to jump the gun in the other direction and just automatically assume, okay, if it's not in the upward direction, it's got to be bearish, right? No, it's more neutral. Just like you can have lower high, lower high, lower high, you can still have low, and higher low, right? You're really just getting range compression out of this as a ratio. XLV does not look like a threat because it's moving in the downward direction. I would love to see financials continue the strength here. That would be a risk-on look breaking out in this ratio. Again, we haven't done it yet, but trying to look for that to continue to propel the market. If we're going to attempt a new all-time high, you really want financials to make that move here in the ratio, or at least see the XLK attempt some sort of equal high, if not higher high. That would be more confidence inspiring for the S&P 500. XLY, somewhat concerning here. As we know, Tesla just had a pretty decent fall from glory, making a substantial move underneath a big prior low. We'll talk about that on the core list of companies momentarily. This is not yet full-fledged risk off. It's starting to threaten a little bit of a higher low consolidation, but we're still underneath that downward sloping 50 SMA, and same thing here in utilities. And I should actually put an X down here, meaning that risk off is not fully a threat yet. We'll keep an eye on those things, but it hasn't really changed tone here. I would say that arguably we have more of a neutral outlook here, still trying to maintain a more bullish small edge with what's maybe happening in financials. If we take a look at some specialized ratios, this is where risk on continues to be the pervasive look. You can see The big move higher here, XLK SHY, risk on. Same thing happens if we look at the XLK XLU. Certainly threatening this, and we've talked about in the past how that's possibly head and shoulders. If we break the neckline, that's where we start to become more concerned. If it's just consolidating up here, again, can't jump the gun considering the historical trend behind us. Let's take a look at the apples to apples XLY XLP, right back down towards the lows after getting back up over these highs, right? And we've talked about this sort of endlessly. I wish that this would firmly just pick a direction and not keep sort of pulling our chain back and forth. It's the market. It's going to do what it's going to do. If it breaks down more aggressively, yeah, it starts to suggest more of a red flag. Risk off is coming back into view. If it just stays sideways, I don't know that I would be overly aggressive one way or another in terms of this particular indicator telling us risk on versus risk off. But we can, provide some more context. We've already looked at two risk on indications, XLK, SHY, and XLU. Let's look at the SMH, XLU, XLV, excuse me, so semis and healthcare, still looking risk on. Still really looking risk on. Does it mean we can afford a pullback? Yeah, of course we can get a pullback here. Of course, that means a little bit of a risk-off switch up, even if it's just momentarily for the S&P 500, but no large concerns with this structural chart overall. Again, I still do think that the bulls have the upper hand in the S&P 500. Here's the dollar moving in the downward direction. Again, kind of surprising that it didn't see a stronger rebound on Tuesday with interest rates kind of ticking in the upward direction, that hot CPI print. Dollar kind of sideways in this range, not really that insightful. And as we know, if we take a look at gold, of course, this is maybe keeping the dollar suppressed here. The breakout just continues. This is totally healthy consolidation near the highs. I hate to be the guy to always say it, but not for nothing, that is still very acceptable out of gold. So unwind more than 50% of the move, but find a structural higher low over the top of 2090. You're going to continue to put downward pressure on the dollar, right? The dollar might rally a little bit as this takes place, but goodness, it certainly looks fine in terms of the magnitude of this breakout on a higher low in gold up and over 2090. And let's just see if silver has anything to say about that. It looks great, right? Silver also finally starting to play a little bit more catch up to the gold contract. So the metals really shining a light, no pun intended, I suppose, on what we might expect out of the dollar moving forward. Let's take a look at interest rates because this is such a big deal with what happened with CPI on Tuesday. So we had broken down in the previous week's worth of trade underneath this as a balance range, right? And you could think of the TNX, although it maybe doesn't feel like it. This is a tradable instrument, right? And you could just always click up the inverse here. So the ZN is going to be your 10-year note, right? And this is the opposite basically of the TNX, and people actively trade this, right? The interest rates are actively in market. But if we just go back over here, because maybe this is a little bit more conceptual to wrap our heads around, it's possible for a lower high here, right? If this is just going to be a big trend reversal to the downside, lower high, breakdown from a balance range, is a very classic setup, right? Reject that as overhead supply here. Makes a lot of sense. And obviously in bonds, you're just looking for a long, right? The ZN being the inverse is just going to be the exact opposite. Let's go ZN, not NQ. There we go. And, you can see here that if we see a stronger pullback towards the zone, buyers are basically looking to do something like this. So we'll see if that plays out in its entirety. But so far, what the implication is for the broad market is that if the TNX rejects there for a lower high, now all of a sudden you're dealing with, again, maybe it's a bit of a stretch to call it a pattern as such, but a lower high and trend continuation to the downside should, in theory, alleviate some pressure over in the NASDAQ, which, of course, is going to be bullish for the S&P as a sort of proxy, right? Let's move along and take a look at the inverted ZT, and then we'll really dive into the Fed tracker tool here and the fundamental take, which is sort of all out of whack right now with the CPI leading to a gap up. But look at your tracker tool, or excuse me, the inverted ZT, which is the 2-year basically, ticking back in the upward direction, and yet the Fed tracker tool is still projecting higher odds for a cut in the June timeframe. Let's break that down. So from a technical point of view so far, everything has looked bullish, and we're really not seeing any changes here for the March or May timeframe on the tracker tool. But here in June is really where we continue to see the almost perverted nature of the market suggest, why is it so obsessed with the first cut coming in June when the labor market remains strong and inflation is still running obviously well above the Fed's target? I do not believe that the market is getting this one right for a cut in June, which is very important to understand. We'll talk about why in just a second, but here we go through the calendar, right? You can see that the core CPI came in hotter than the expectation. Not only was the expectation for a 0.3, which annualizes obviously nowhere close to the Fed's target, but we missed that. Obviously, the same thing happens here at a 0.4 on the non-core, and the CPI year over year misses and actually sees a tick in the upward direction to 3.2. Once again, not even close to the Fed's target of 2%. So why does the market continue to see higher odds for a cut in June? What is it seeing that maybe we don't see? I haven't seen anything in the labor reports yet that is like, oh my goodness, we're going to be, going towards a recession very promptly. It hasn't happened. I mean, the weekly initial claims are not there. Last Friday's report really wasn't all that bad. A small uptick, but nothing to the degree of, oh my goodness, recession is around the corner. We'll see if the Empire State Manufacturing comes in at that -7. If you take a look at the prior read, this is the worst one we've seen since the sickness, right? So that's worth watching out for to see what's going on in manufacturing. But outside of that, the inflation risk. So remember that in the last SEP, Jerome Powell really made note that they were trying to more appropriately balance the risks of the labor market and the dual mandate, so maximum employment and price stability. They made note that, okay, we're making progress on inflation. We're not all the way there yet. We'd like to see more progress, but we're starting to consider the risks to the labor market. As of right now, we've stagnated over here. If we take a look at a couple of metrics of inflation, we've basically found a floor at 3%, right? Even just slightly above 3%. You can see that not much more aggressive trend continuation has happened here out of inflation. And this is CPI year over year, right? If we take a look at another possible illustration here, this was one of the larger things that everybody was rallying behind. And even myself, I was like, okay, this is encouraging data, right? The 3-month annualized change in inflation was rapidly approaching and continuously touching 2%. So that looks like we're making progress on the inflation front here in white at 2%. Great, we're making decent progress, but look at what's happening. We keep bouncing off of that. We cannot seem to get underneath, which is not good enough when we're coming from above 2%. Obviously, that sort of speaks for itself. And we could take it one step further. Michael McDonough is doing some great work, I believe this is his work, on the diffusion indexes for CPI. And the main thing, forget about all these lines and being overwhelmed. The one that you should pay attention to is this yellow box right here, the yellow box and the yellow line. Over 2%. How much of the inflation metric is contributing to over 2%? 67.3% of the inflation read is over 2%. So if you want to talk about making progress on inflation, this needs to be, well under 50% if you're going to get a 2% net read on inflation, right? And if you take a look one step further, this is the contributions over 4%. Right? Month over month annualized, 63% of things are over 4% in the CPI read. I know that's a lot to digest, and I know that diffusion models are not necessarily like, oh my goodness, every trader knows about these things. But if we're really diving into what CPI is actually doing, we've stagnated. This moving in the upward direction is unacceptable. If we go just back to the previous in yellow, we're moving lower, but does this flatten out? That's one of the largest risks I could see for this market as of right now. So really interesting stuff. And if price stability is not achieved, if we cannot hit this part of the dual mandate from the Fed and we do not get a cut, remember the market is fairly certain right now, maybe not fairly certain, but it's leaning towards a cut in June. Let's tie the bow. Let's finish the knot here. Why is this so important? Because if we remember back to the earnings insights, when is the market pricing in an advance in corporate earnings? Q2 of 2024. What does that align with? Obviously June, right? So if this is going to take place and the market's anticipating this cut and it doesn't take place, what would that imply for S&P earnings? Certainly does not bode well for oh my goodness, here's this big push as a tailwind for corporate earnings. So really paying attention to this dynamic from a fundamental point of view. So we've tied the knot fundamentally here, and we can take a look at what's happening this week for earnings. I would say obviously Thursday after the close tomorrow, it's all about Adobe to sort of finish us off. But this is the fundamental path. Right? We've already talked about, and this is why it's buried in the sort of back half of the video, we've talked about the technicals, and the technicals represent what's actually happening on a day-to-day basis. I would not fight that. When and if we fall into a technical downtrend and we're still seeing reads here that aren't making sense and the fundamental story is still puzzled and not really adding up to an S&P that should be trading at all-time highs, then we'll strike and we'll say, you know what, the structure is bearish. We finally slipped into a downtrend. We have reason to believe that this is not the accurate price for the S&P. If you want to be contrarian, be my guest, but that is not the approach I would take to the market, right? The technicals are what's actually happening in front of our very eyes. That's the activity we trade. This speaks to context, and if we need to change our tone, this gives us an additional sort of boost of confidence to say, okay, I at least understand what's happening here and what the market's starting to see. So with that said, let's get back to the technicals and take a look at risk appetite. no surprises here. TLT ratioed to the S&P, drifting back down towards the equal lows. We already talked about how it was down 1.6% on the week, so all good. There is no flight to safety that's unfolding in terms of bonds. If we take a look at bonds in relationship to themselves, a little bit of an uptick this week. You can see here, here, and here, but still looking for the opportunity of a lower high, and a lower high. If they do produce lower highs and continue in the downward direction, that is constructive for risk appetite in equities down below, long duration risk assets, right? Credit spreads moving in the downward direction. This is good. This is healthy. This is reducing the risk of a credit event and some sort of catastrophe, if you will, that really shakes things up in the market. So all good on that front. That is bullish across the board. HYG not threatening. So junk bonds in isolation, not threatening a breakdown of the 7660, really producing these equal highs in the S&P. I understand, yes, we're divergent from here to here. I get it, but at least this is not divergent in the immediate term in the S&Ps. Remember, the largest concern is when and if we break that 7660 as the S&Ps continue to chug along in the upward direction. We're not there yet, not overly concerned, but still highly attentive to the divergence in the grand scheme of things. Let's take a look at Bitcoin. Continues to just rip in the upward direction. This, of course, is bullish and speaks to strong risk appetite in general for financial products. If we take a look at market breadth, a little bit of a pullback this week, but still elevated, certainly still positive over the zero line, which is the most important factor. If we take a look at the SPX A200R, making a tick in the upward direction this week, that of course is bullish. SPX A50R, a little bit of consolidation here, but remember, we're well off of the lows here at the 50% mark and well above the neckline of the inverted head and shoulders. So far so good. As we start to get into overbought territory, maybe there's some cooling off that takes place in the market, but I wouldn't look at this and just say, oh my goodness, here comes the short because the SPX A50R is over 80%. That's not really how this works as an indicator, right? Let's take a look at the RSP and see what's going on over here. Still floating near those all-time highs. Bullish balance up here. Actually, like if we're going to split hairs, high of this bar is 166.72. High of this bar is 166.82. New all-time high by 10 cents today on the equal weight S&P 500. That has to strike me as a bullish indication. QQQE trading in lockstep with the weighted down below. Possibly an opportunity for a stronger higher low actually out of the QQQE, where instead down here in the weighted, we're more on par with an equal low. So, so far, if we're talking about market breadth is actually improving as this rally is progressing towards those highs. So, as I continue to sort of weigh all of the data points, right, we're in technical uptrends. We know that we have room for a higher high to break out, at least in the S&Ps. We know that breadth is improving. We know that risk appetite remains strong. We know that there really aren't stronger sellers. It still, again, just all adds up to me to say, hey, do not step in front of the market right now. Do not try to be the hero and pick the all-time high. Dow Jones is making a new all-time high as transports are continuing to just stay sort of compressed in this range. Again, not enough evidence by itself to really suggest a new, short in the S&P 500. So we'll let that be. If you're a Dow trader, I'm sure you have more insights than I do on that. But anyways, VIX is up next. VIX volatility, right? What do we see out of vol? If we break down through this trend line, maybe we see some relief on the NVIDIA options chain. I highly doubt it, but if we break down underneath the trend line, that would of course support, in theory, a bullish move out of the S&P. Let's see if they give us the quote classic VIX crush Friday. Post, obviously, or maybe it's not so obvious, but the futures options expire in the morning. The futures settle in the morning. So into Friday afternoon, you could see volatility actually flush out of the marketplace once that expiration has taken place. And, all of the hedges, all the market makers, all of whoever with the big money, quote, air quotes, big money, when those guys are out, right, as volatility possibly comes out of the market underneath 15, in theory, alleviates some pressure out of the S&P. If it's just everything going to hell in a handbasket on that expiration, maybe we accelerate here, but why do I not believe that that is likely? Let's take a look at the VVIX, right? Even with what's happened on the gap down on Monday, we were lower on Monday in the VVIX instead of accelerating there, after the bearish engulfer. So I'm not really convinced that volatility is poised for this nasty explosion in the upward direction. I mean, if we're over 103 into the end of this week, let's say that Thursday looks like this, Friday is like that, yeah, I'll change my tone, and I probably set some alerts. Actually, let's do it together here right now. Let's just create an alert. Let's go at or above, fine, and let's just drag this thing slightly below the level. That's fantastic there at 101, great. If we get over that, that, sure, I'll be aware of it, but really not forecasting that as a high probability outcome. Let's take a look at the VIX futures just to see if we're in contango. The answer is yes, not close to a backwardation. We will have to roll these shortly. This is looking a little bit sort of interesting here in the 9 versus 30-day VIX, but the 1-day is sort of keeping us sane back down towards these equal lows. So volatility, not really much of an issue. We haven't checked in on skew in quite some time, so let's do it together. We're just sort of hanging out near these highs, just as a reminder. Becomes much more important at the lows 113 to pick some sort of bottom. Everybody throws in the towel. People are still pretty skeptical based on this elevated skew, but it's not enough to, again, go out there and short the market. Unless you want to be disappointed over and over and over again, it's usually not a repeatable strategy. So with that said, let's move into the core list of companies. If you've made it to this point in the show, I'm sure you're enjoying the analysis. Do me a favor, hit the thumbs up button and subscribe. Remember, 100K by May, and we'll kick off the core list of companies with none other than Apple on the daily time frame chart. I want you to be acutely aware of this level right here at 167, previous breakout level, as well as support in here on the retest from something like a monthly point of view. But that is a possible target within reach into the end of this week at 167. If we break down underneath, the door is open into 162.75, then 155.50 is actually a weekly level. If we go on out to a weekly, look at this, previous rejection points broke out. That's really what led to the mechanical breakout all through the early stages of 2023, right? If we just bring it back down to the daily and actually flip over to the hourly, right? What I want to try to illustrate here is that the bears are in control. Obviously, this as a descending triangle has already broken down, and we're attempting to find a lower high. The lower high makes a lot of sense to me because this is a gap fill reversal. It's rejection of this low. Remember that there is your gap on the Tuesday session of last week. You'll notice that we tried to get acceptance up here, even look at the lower wick on the Tuesday session low, but today it's all flattened with the acceptance into the afternoon underneath 172. So for that reason, I would try to align with any continued lower highs under 172 trading into 169. Then below that is the daily inflection point we just highlighted at 167. We've already talked about downside levels from there. There is a caveat to this potential chart though, and this comes from a very classic setup. We talk about it most mornings in the pre-market prep whenever the setup presents itself, right? When you get an opening drive in a particular direction and then you get consolidation sideways for the afternoon, if you can pop that consolidation high, you're looking for a short scalp. Short scalp isn't time frame scalp, or like short duration scalp. Obviously, it would be a long trade here up and over these highs, but you're not overstaying your welcome. This is not a trade on Apple to get to 180, 190, back to all-time highs. This is a scalp to get back to the previous day's opening print. So don't misinterpret what I'm saying here, but over 172 could squeeze out some of the shorts late to the party, retarget the opening print. I'll show you a perfect example of that over on Tesla as we work our way through the core list of companies. To be more confident in longs out of Apple, it's got to be a higher low up here for a stronger counter trend move back to the daily chart. If we take a closer look, stronger counter trend move for this gap, or possibly the reattempt of the breakdown level at 180.25. One step at a time, possible scalp in the upward direction tomorrow, but not seeing anything concrete for a stronger upside trade. Next up, Microsoft. What do we see? Moving back towards the top of a daily balance range. Decent look here. Ideally, we find higher lows now over this level at 412.50. That's exactly the lower wick of today's session. And the reason for this is coming from back here when this break to an all-time high was made. So far, this consolidation is looking like a weekly bull flag. If we're going to turn it into some sort of pennant, you want to start seeing higher lows for progress being made on the bull side, breaks into blue sky territories, whole and half dollars, intraday levels that form. If we take a look at the hourly time frame chart, let's zoom in on this side of things. And you can start to see as well that this represents this thin structure, right? So this breakdown was thin structure. If we can stay over this level, previous resistance, support in here, that's making a lot of logical sense. I mean, ideally, yes, you could get something that does this, or perhaps maybe not. Ideally wasn't the right word, but rather, the line in the sand would be at 409.50 as a double bottom neckline reattempt. But this, rather, to use the word ideally more appropriately, is ideal, right? Consolidation over 412.50 for all the reasons we've just described. This low, rejection. If we could stay above it, it's beautiful consolidation here on the hourly, looking for the break over time, and that's new all-time highs. If the bears are going to make progress, it's got to be a lower high underneath, 409.50. Next up, GOOGL. What do we see out of Google? Actually, pretty impressed with the move out of Google. I thought that we were for sure going to start seeing some weakness out of sort of again, we talked about it in the pre-market show. ascending or rising wedge rather. Break down through that, you have trapped overhead supply. They actually followed through up and over this as a neckline, and now the name of the game is just staying above. So any higher lows over 138.75, looking for longs in this area. If we can spot it, trading back up to the equal high, and then the gap closes a target overhead. Over 142.50 closes at 143.50. If the bears are going to make progress, it's this level at 137.65. Breaking down from that with a lower high underneath turns these buyers late to the party near the neckline of what was starting to look more like an inverted head and shoulders. Those buyers late to the party here turn into overhead supply on a lower high below 137.65. So your shorts are being patient for this level right around over here. I would not jump the gun on something that does this. All right, so be patient out of Google shorts. Next up, Amazon, Nancy. What do we see out of Nancy? Possibility, this just caught my eye as we were slightly zoomed out, for a trendline break tomorrow to fill the triangle up towards the equal highs up here. Not yet all-time highs. There's a little bit further overhead. But one of the things that strikes me as constructive is today's pullback higher low over the 176 level coming from this area here, right? Rejection, double bottom neckline. Couldn't really hold above it. Found that consolidation underneath, chopped through it there. So as long as we're over 176, giving the buyers the benefit of the doubt for some attempt at a higher low, break the trend line, and we already talked about an equal high being attempted, closer to that 179.50 from there. Any breaks, you've got some room to run up towards 185.25. Bears, you had your opportunity, right? I continue to fall back on this sort of idea where if the bears were given a gift here, why could they not materialize for a gap close? Why were the buyers able to send it right back up towards these highs? You know, it's just like it's a passing of the gift back and forth. And right now, the buyers have the gift being over 176. So attempting to align with those buyers and looking for that upside. Bears, you know, maybe we'll pass it back to you at some point, but it's got to be for the gap close at this point underneath 172.35. Next up, NVIDIA, the one stock to rule them all. Let's go back to a daily time frame chart. Let's quickly throw on our IV rank. In the options selling setup, you can see we've still got a higher IV rank than what we had on earnings. So for that reason, I'm really not interested in trading NVIDIA here. I think that the juice is not worth the squeeze. Let's just put this back on here. Let's take a closer look. So, I mean, inside bar, yes. Is it possible that if you pop these highs at 922, you go back to the all-time high? Sure. If we take a look at the hourly time frame chart, you know, that's holding this. That's consolidating here. It's breaking its higher lows over the 922. You've got thin structure to retrace. Your high would be a test of this level at 972, not 01. You guys know the rules up here in the penthouse. There we go. So, I mean, you've got your structure in front of you, but be my guest if you want to frolic in IV. That is like more so elevated than what we have on earnings. So, as a substitute today, let's take a look at AMD breaking down today underneath this level right here. So, this actually reminds me of what's happening in Apple, right? Apple has that consolidation underneath the level. If we can continue to reject underneath, we have thin structure to retrace. The next big level is 183.60. So watching for that to the downside. If we pop it, just like Apple, it's a squeeze. It's not, oh my God, AMD is going up to 225. It's no, we're looking at this structure here at 203.15 to squeeze out the shorts and possibly an equal high. If that materializes, great. We have a look below and fail. And then over time, if we were to snap the high of the range, great. Now we'll trade back in the upward direction. But until actually proven, I would align more so with the bears on continued lower highs underneath 197.40. So there's a quick roadmap on AMD as a substitute for NVIDIA. Here's Metaverse, what's going on with Zuckerberg's Fantasyland balance. So be my guest if you want to get chopped up in the range. I think that this is a keep it simple, stupid. You know, there you go. Higher lows over 499.75, 500, 503 as a zone. Or on the short side, I don't know that I would really participate firmly underneath 490. I mean, be my guest if you want to take a stab at it. But for me, more so aligned with Amazon, I would look for the gap to close as the short setup. So under 482, become a little bit more interested in shorts for now. Consolidation until proven otherwise. Next up, Tesla. Just to show you the example of the Apple trade, right? Here is the opening drive to the downside. There is your consolidation highs. There's the squeeze, right? It's not, oh my God, Tesla's going back to 200. It's no, Tesla can reattempt the top of the range, right? So that's the exact trade that you look for, which will apply to Apple and, as we just saw, AMD. But regardless, Tesla is now breaking down underneath the bottom of this as a range. So what does the daily time frame chart look like? It's a continuation of this as a downtrend, right? Lower lows are on the table, and we're looking for these retest points down below. 165.75 and 159 flat are our targets to the downside. Looking for continuation. If we take a closer look at the daily, and just do a little something that does this. If we were to get a pure range double of this particular zone, based on a quick eyeball test, 165.75 is not all that far out of the picture from there, right? So let's say that we get there, then there's a counter trend. You're just looking for a subsequent lower high underneath this level at 173.15. If the buyers are going to step up and make something meaningful happen here, it's got to be a higher low over 182. So Tesla, let it be on the long side. You know, if you're scalping it, that's great. Be my guest. But the better structural trades, like here we go for continuation, definitely on the short side here out of Tesla. The daily chart would definitely agree with that one. Netflix is going to finish up the core list of companies, and I've got 3 additional ideas for you. Here's a balance range. Again, keep it simple. It really reminds me more so of Meta. Higher lows over 616, and you've got some range to trade for 644.75, or breakdowns of this set of lows here at 590.25 change tone for a gap close down below, and possibly a reattempt to this area at 569. That is the core list. Let's continue along with 3 ideas. First up is COST, Costco. What's going on over here after earnings? A little bit of a debacle to the downside, right? Gap down from these all-time highs. Pretty pricey stock these days. So everybody who's paying a Costco membership, just know that you've got a small part in this $730 product here. We've got ourselves a potential weekly higher low off of the daily 50 SMA. There was some damage done here. If the buyers are going to step in and really see this thing through all the way up to a gap close, we've got a bullish 3-bar play setting up on the daily time frame chart. Here it is on the hourly. Very simple setup, right? If you can break this high, look left, you've got thin structure. If there's momentum in the broad market, if the broad market is moving higher tomorrow, if the S&Ps are reaching for all-time highs, great. Looking for that move over 738 through the thin structure to attempt the bottom of the gap at 756. Follow through from there. 777 is the gap close. I'm interested as long as the consolidation is here. If we break down underneath, starting to lose interest. I might keep it on a back burner, and then certainly not interested if we take out these lows closer to the daily 50 SMA. So watching Costco for a possible long if the broad market wants to cooperate. Let's take a look at next up is IBM, the good old international business machine. Shout out to Paul Rand on the manual there, the identity manual. So very classic, right? Very, very classic. So what we see out of IBM is a cup and handle, and there you have it. If we move higher, all-time high is really not that far away. Over 198.25, trades up into 206, and we have ourselves a 3-bar play. It's almost similar to what we just talked about in Costco, but the context is slightly different. Here it is. I would suppose that as long as we're over 195.50, that's like rainbows and butterflies, but as long as the handle is really building out, and sorry about that, you guys know the rules, so let's just delete that 6. As long as we're in the handle, I wouldn't really take this one off watch. The trend is certainly strong. We have decent tailwinds. If we break down through the handle low, different concern under 191. Maybe it finds its way off of our watch list. Last but certainly not least is TTD, the trade desk. I don't have any insights on their artists and what's happening over here, but the trade desk, short, right? This is a short. We just talked about 2 longs. This is definitely a short with a descending triangle into a flush point and a gap to close underneath from earnings, back down towards your daily 200 SMA in green here. Underneath 80, closes down towards 76.10. If we take a look at the hourly time frame chart, there's not much going on here to point out other than the consecutive lower highs coming into the flat bottom. I think the threat is there. So on a bullish broad market, I would focus more so on Costco and IBM. On a bearish broad market, I would be thinking about the trade desk closing the gap underneath to retest the daily 200 SMA. Under 80, trades into 76.10. If we're just chopping around in here, it's sort of not very interesting to me. I don't see a very clean structural setup in this particular zone. So more interested in just watching the short out of the trade desk. That's ultimately going to do it for today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. Remember, 100K by May. It's a very ambitious goal, but we'll see if we can ultimately do it. We will be live tomorrow morning at 8:15 Eastern up here in the penthouse for the live pre-market prep. Come join us. It's not coffee and donuts, just coffee tomorrow for the unemployment claims. We'll also be getting the PPI and the retail sales tomorrow morning, so it'll be a decent morning to watch out for some volatility. And then on Friday, certainly inflation expectations. So come hang out. And with that said, I wish you a green trading week.